have you ever wondered if the grand structures of nations, the very states we live in, could actually unravel? And not in some sudden dramatic event, but maybe through a predictable, almost archetypal process. A process so well worn it even has a kind of blueprint. Welcome to the Deep Dive, where we take your sources and unpack the most fascinating insights. Today, we're diving into a collection of really compelling articles that lay out a stark vision of state collapse, global debt cycles, and frankly, an incredibly bold and, well, unsettling claim about a singular, overarching legal framework that's supposedly already in place.
Yeah, what's truly fascinating here, I think, is how these sources connect the dots between things that seem pretty separate.
Hmm.
Things like routine budget deficits, the rise of political instability, and even really complex international law. They use these to paint a picture of how entire states can, in a very real and legal sense, just cease to exist under international law.
Mm.
It's a pretty comprehensive view that definitely challenges conventional thinking. It forces you to consider the systemic pressures kind of lurking beneath the surface of global events.
Absolutely. So our mission today is to explore what the sources call the archetypal course of state debt crisis. It's a detailed 9-stage pattern. They lay out basically this blueprint for decline. Then we'll try to ground this theory in a monumental case study, the United States. We'll chart its journey through these very phases over the last 80 years or so. And here's where it gets really interesting. We'll delve into the extraordinary claims of a document called the World Succession Deed 1998. This thing supposedly kicks in automatically when a state collapses, essentially predetermining its legal fate, which
Yeah.
is, wow. And finally, we'll confront a dark, often asked historical question. Can war ever truly be a solution to financial problems, or is that just a dangerous myth?
Right. This deep dive, it promises to deliver more than just facts. It's really aiming for those aha moments, helping you understand the deep systemic pressures that can lead to these profound global shifts. You'll hopefully gain a new lens to view current events through, and maybe understand why critical thinking about our economic and legal structures is more vital than ever. And we're going to use specific details, anecdotes, and direct quotes from these sources to try and bring these complex, almost unbelievable ideas to life for you.
Okay, let's unpack this. We begin with the universal logic behind how states go broke, because according to these sources, it's definitely not random. So the sources reveal that state bankruptcy isn't arbitrary. It follows this clear historical 9-stage pattern. It's almost like a blueprint for decline, right? A predictable downward spiral that, once started, seems incredibly difficult to stop, with each stage just feeding into the next.
Indeed, yeah. These stages meticulously show how financial instability, political failure, and monetary policy abuse systematically lead to collapse. The key insight, according to the sources, is pretty profound. Every collapsed state in modern times went through this pattern, even if the timing and triggers varied. This framework, which is influenced by works like Ray Dalio's Big Debt Crises, it suggests a universal mechanism, a kind of economic and political gravitational pull towards insolvency if certain conditions are met and, well, left unaddressed. It really underscores that this isn't just about individual nations failing because of unique circumstances, but maybe a common trajectory driven by similar, repeatable financial and political dynamics.
So if it's a blueprint, how does it all begin? Stage 1. Budget deficits steadily rise. It sounds pretty innocuous at first, like just a little bit of overspending maybe. What are the earliest warning signs that this manageable deficit is turning into something more ingrained, more dangerous?
Well, it starts subtly. The state consistently spends more money than it takes in through revenue. This often happens during times of political or economic uncertainty. Maybe they're financing social programs to, keep people happy, or military endeavors, crisis measures like during a pandemic, or just trying to stimulate a sluggish economy. The sources quote, "Governments love to be popular, and popularity is bought through spending." Makes sense, right? The initial deficits, like you said, they seem manageable because investors still have confidence the state can pay its debts back. But the shift from manageable to dangerous, that usually happens when the political will to cut spending or raise taxes just evaporates. And the deficit becomes a structural annual expectation, not just a temporary fix. And that trust, it gets squandered pretty quickly once deficit spending becomes a habit.
So, buying popularity with borrowed money. And the first deficits seem okay because investors still trust you. But that trust gets burned if spending becomes the norm. It's like using a credit card for everyday groceries, thinking you'll pay it off next month, but then realizing you're just racking up more and more debt year after year with no real plan to stop.
Precisely. And that brings us to stage 2. Debt grows faster than the economy. This is where the debt trap really starts to form. The debt to GDP ratio, that's the key metric, starts rising exponentially. It means the state's revenue just isn't keeping pace with its borrowing. It's not just the total amount of debt, it's the growth of that debt relative to the economy's ability to generate income. The sources are really clear on this fundamental economic principle. Debt cannot grow faster than income forever. If it does, the system collapses. When a nation's total debt consistently outstrips its economic output, well, that signals an unsustainable path. It inevitably leads to trouble down the road.
And at this point, you're telling us uncertainty in the capital markets starts creeping in, particularly for long-term government bonds. That's a big red flag for savvy investors, isn't it? They start demanding higher returns for the risk they see. They're basically saying, we're not so sure you'll be able to pay us back in 20 or 30 years, and they start pulling their money out or asking for more interest.
Exactly right, which leads directly into stage 3. Interest burdens explode. The rising debt burden means rapidly increasing interest expenses for the government. Soon, a significant portion of the budget is no longer used for education, security, or infrastructure, but only for debt service. This is a critical turning point because it shows the government's fiscal priorities are shifting dramatically. They're moving away from providing essential public services and investing in the nation's future towards simply servicing its past borrowing, paying the interest on the credit card, essentially.
That's a really powerful visual. Tax revenues just flowing out to pay interest, not for schools, not for hospitals, not for roads. So the real aha here isn't just the rising debt number, but how the state, which is meant to serve its people, quietly shifts its main function to just existing, to pay off past mistakes. It's like a silent erosion of its purpose. The sources say this undermines social peace, and the state loses its fiscal room to maneuver. It starts incurring new debts just to service the old ones. That's the classic debt cascade model, right? Borrowing just to stay afloat.
Which brings us to stage 4, dependence on the central bank. At this point, the market truly loses confidence. Traditional investors, seeing the risk and maybe a lack of a clear plan, demand higher and higher interest rates, or they just stop buying government bonds altogether. This is the moment when the central bank intervenes through quantitative easing, i.e. buying government bonds with printed money. This becomes the government's last resort to get funding because the private market isn't willing or able to absorb the debt anymore at rates the government can afford.
Okay, so the central bank becomes the buyer of last resort, effectively monetizing the national debt by creating new money. Let's be absolutely clear for our listeners. What does quantitative easing actually mean in simple terms? Is it literally just printing money, or is it more complicated? Because the sources warn that this process always ends in inflation.
Well, in simple terms, yeah, it's very much like printing money, although it's usually done electronically these days. The central bank creates new money out of thin air and uses it to buy government bonds, usually from commercial banks or other big financial institutions. This injects liquidity cash into the financial system, pushes interest rates down even further, and the aim is to stimulate the economy, encourage lending and investment. But, as the sources clearly state, when you dramatically increase the money supply without a corresponding increase in real goods and services being produced, well, the value of each dollar, each pound, each euro falls. And that, almost inevitably, always ends in inflation. It's an almost unavoidable consequence. More money chasing the same amount of stuff means prices go up.
Right. Stage 5, inflation and currency depreciation. With too much money sloshing around, basic economics kicks in. Prices skyrocket. Inflation eats away at purchasing power, destroys savings, and particularly affects the middle class. This group, often relying on fixed incomes or the savings they've built up over years, sees their financial security just vanish. The currency loses credibility, both at home as people struggle to afford things, and internationally as global markets devalue it.
And you can see why this would be terrifying for people, right?
Yeah.
Imagine your life savings diminishing in value day by day, losing huge chunks of buying power. When confidence in money wanes, real goods are preferred. Real estate, gold, food, the sources note. People instinctively turn to tangible assets, things they can touch, as a hedge against a currency becoming worthless. And in this phase, capital flight begins. Those who can start transferring their assets abroad, which further weakens the currency and deepens the crisis at home.
Which leads us straight into stage 6. Political instability and populism. As poverty, unemployment, and these massive price explosions hit the population, the reaction is often protest, radicalization, and polarization. Economic hardship spills over into social unrest.
Exactly. Populist parties gain popularity often with extreme positions, offering simplistic solutions and scapegoats for really complex problems. These parties tap into that widespread frustration and desperation, making grand promises that appeal to people feeling increasingly vulnerable and unheard.
This sounds depressingly familiar from history books, doesn't it? We've seen this pattern play out time and again. When systems fail, people look for easy answers, and often for strong leaders who promise to fix everything, no matter the cost. State institutions, which maybe once commanded respect and authority, start to lose their grip. And in this environment, democracy itself can be undermined or even replaced by emergency powers as governments try to restore order through increasingly authoritarian means.
And that's stage 7, capital controls and repression. To try and slow the collapse, or at least control it, governments resort to more authoritarian measures. This includes things like the introduction of cash limits, prohibition of capital exports, control of exchange rates, basically trying to stop money leaving the country or losing value too quickly. The sources also mention the potential introduction of digital central bank currencies with control, which hints at a future where maybe even individual financial transactions could be monitored and restricted. That gives the state unprecedented oversight over citizens' finances.
So a really dramatic shift from trust to control. The sources frame this directly. Trust is replaced by control, freedom by surveillance. That quote is quite chilling. Do the sources explain how that loss of trust directly fuels the need for surveillance, and what's the outcome of that repression? Is it effective?
They do. They explain that as the state loses credibility and people lose faith in its currency and institutions, people naturally seek ways to protect themselves, often by moving assets out or using barter or engaging in black markets and formal economies. The government sees this as a threat to its dwindling control and responds with tighter restrictions, more surveillance. But crucially, the sources point out that this repression only accelerates the loss of trust. It creates a vicious cycle. The control measures meant to stabilize things actually end up destabilizing the system further by alienating the population, driving more activity underground, and pushing the state closer to the brink. It backfires.
Which brings us to stage 8, default or currency reform.
Exactly. At this critical point, the state simply can no longer service its debts, either domestically or abroad. It's run out of options. Its popularity is gone, its access to markets is gone, its central bank's tools are exhausted. This inevitably leads to either a default, a formal declaration that it can't meet its financial obligations, or a currency reform, which is essentially a drastic devaluation where all monetary values are reset, effectively wiped clean, and restarted. It's a painful admission of total failure.
When the central bank can no longer save, the illusion ends. Debts are canceled, currencies are newly created. This step marks the end of the state's monetary system, a complete reset of the financial architecture. It's basically acknowledging the old system has utterly failed, and a new one, even if devalued and carrying very little trust, has to be put in place just to move forward. The old promises are just gone.
And that leads to the final devastating phase, stage 9. System collapse and institutional dissolution. Here, the state itself breaks apart. Its very essence dissolves. Institutions lose their function. Administration, the judiciary, they cease operations. The basic functions of governance, collecting taxes, providing justice, maintaining order, even keeping the lights on, they just stop. The state is no longer capable of acting, not even externally. It loses its standing on the international stage, unable to conduct diplomacy or even enforce its own borders effectively.
The sources give us a really haunting quote here. A state dies first in its numbers, then in its language, and finally in its capacity to act. It illustrates this progressive decay, right? Where financial and social breakdown leads to an existential crisis for the state itself. And this ultimate collapse leads to a profound legal consequence, one that I think most people never consider. The state no longer exists under international law. And that, as you mentioned, raises this monumental question of state succession, what fills the void? What happens legally when a sovereign entity just disappears? What framework steps in? Okay, this is where our deep dive takes an extraordinary, maybe even slightly sci-fi turn. We've talked about the economic and political collapse, the tangible unraveling of a nation, but now the sources introduce a specific legal document with absolutely sweeping implications, one that claims to be ready to fill that very void. This sounds almost unbelievable. What on earth could this document be?
It is definitely a claim that defies conventional understanding of international law. It introduces a whole new dimension to state collapse. The sources state that at the exact point of system collapse, specifically when a state hits the criteria of that final phase, insolvency, political incapacity, institutional dissolution, complete loss of confidence in the currency, and international legal automatism comes into force. They name it. the World Succession Deed 14798 automatically comes into force. And this isn't presented as a theory or a proposal. It's presented as an established, pre-existing legal mechanism, just waiting for its trigger condition.
A legal automatism. Okay, just to be crystal clear, this isn't something that needs a new vote or a treaty signing or a UN resolution. It's more like a legal if-then statement that just executes on its own when the conditions are met. That sounds incredibly powerful, almost like a pre-programmed global switch. What exactly does this deed claim to do?
That's precisely the description. It's presented as self-executing. The deed is described as a complex legal work with several central elements. Its core premise, according to the sources, is to define what happens when a state disappears and who then becomes its legal successor. So it's not about chaos or a power vacuum. It's about an orderly, predetermined legal transition, supposedly agreed upon long in advance, to ensure there's no legal ambiguity when a state fails.
And it activates automatically.
The sources reiterate that throughout. The deed 1.198 is automatically activated when a state hits those final phase criteria. Insolvency, incapacity, dissolution, loss of currency confidence. It doesn't wait for any political decision, any court ruling. It's presented as a preordained legal outcome, a self-executing mechanism. It's almost as if the legal parameters for what happens after collapse have already been settled.
So no vacuum. Instead, an internationally, legally fully fulfilled treaty just clicks into place. That suggests a level of planning and foresight that is, well, quite extraordinary, almost anticipating the failure of states as a predictable event.
And it supposedly creates a global legal anchor. The deed references earlier transfer agreements, including some involving the Dutch armed forces and NATO missions. According to the sources, this activates the entire NATO-UN treaty chain. So the deed isn't some isolated document. It's claimed to be deeply interwoven into existing international military and political frameworks, drawing authority from and extending its reach through these established agreements. It's like a legal cascade.
And the sources emphasize this isn't just a partial transfer of power or assets. It's a sale with all rights, obligations, and components. What does that truly encompass? Does it mean literally everything associated with that state, its laws, its territory, its infrastructure?
According to the sources, yes, everything. This includes jurisdiction, all physical and digital infrastructure, telecommunication networks, and all sovereign rights. These are globally transferred to the buyer. It's presented as a complete legal absorption, a total transfer of all governmental functions and territorial control. So yes, that would presumably encompass everything from legal authority over its citizens to physical assets like roads, power grids, internet cables, even national archives. Supposedly, nothing is left behind.
And how does it achieve this global reach? The sources mention two chains.
Right, two primary mechanisms or chains. The first chain connects stationing law that governs foreign military presence to NATO, and then onward to the United Nations. This suggests a military political framework for its activation and enforcement, leveraging established defense and international cooperation agreements.
Okay, and the second chain. That sounds particularly pervasive, touching on our interconnected digital world. How does that one work?
It does sound pervasive. The second chain links the ITU, that's the International Telecommunication Union, the UN Agency for Information and Communication Tech, to international telecommunication networks, then to all individual connections, and through this achieves a worldwide expansion via network connections. This highlights the often unseen legal implications of our digital world. It asserts that control over global communication infrastructure can translate into broader legal and territorial authority, essentially binding nations through their digital arteries.
Wow, and there's a domino effect.
Yes, the sources describe a domino effect central to this territorial expansion. The sale of development units, things like cables, lines, roads, leads to an automatic expansion of territorial validity. The claim is every connected line, every connected network infrastructure draws the next territory into the scope. So it's not about traditional borders or treaties, but about the physical and digital threads that connect the world. If you're connected, you're potentially included.
That's a truly unique claim about how territory can be legally acquired, not through conquest or treaty, but through infrastructure linkage. It's almost like an organic growth of legal reach, very different.
And critically, the sources state, there is only one internationally recognized successor for collapsing states, the buyer of this deed. This effectively eliminates any other claimants, prevents disputes over succession, and creates a singular, predefined legal outcome for any state that collapses under these specific conditions. It supposedly streamlines the whole messy process.
Okay, this part's particularly striking. The deed names Landau in the Palatinate as the place of jurisdiction, not a specific court or tribunal. That sounds incredibly specific, yet vague. What's the implication of naming a place, not an institution? Do the sources explain how this global jurisdiction works in practice or how it interacts with existing legal systems?
It is a very peculiar detail, isn't it? The sources explain it this way. The institution is the buyer. The jurisdiction is global. It implies that the buyer not only assumes rights, but also global jurisdiction. The absence of a specific court suggests the buyer themselves becomes the ultimate arbiter for all legal matters arising from the collapsed state, acting as a singular supreme legal authority. As for practical examples or interaction with existing systems, the sources really emphasize that the deed's power comes from its existence and the tacit consent of other states through their non-contestation over time. It's presented more as an underlying established legal reality rather than something actively argued in conventional courts yet.
So, if we connect the darks, the deed effectively claims to replace national constitutional courts, international arbitration courts, even UN bodies, establishing the only remaining instance for all international disputes. Military, civil, sovereign, that's a profound centralization of legal power, a complete reordering of global justice as we know it.
And the sources make an astounding claim to back this up. Since no other state, no organization, and no subject of international law has contradicted the deed, the global effect came into legally binding force, internationally recognized by tacit consent. A paraphrase quote states, "With the notarization, possession passes to the buyer. A new legal order begins." This idea of tacit consent is key. It suggests validity isn't from active agreement, but from the absence of formal objection within a certain time frame, giving it what the sources assert is universally recognized legal weight, a very specific legal argument.
You're saying this one deed implicitly integrates all these major international agreements, NATO, UN, ITU, effectively creating a super treaty that overrides everything else, like a new operating system for global law. That's quite a claim.
Yes, that is precisely the claim made in the sources. They list a whole raft of foundational international agreements. NATO statutes, U-NATO agreements, the ITU Convention, telecommunication treaties, infrastructure agreements, host nation support agreements with the US, UK, Canada, even German-Dutch cooperation deals. The assertion is that this effectively creates a single global treaty encompassing all military, civil, communicative, and sovereign rights. It supposedly streamlines and centralizes international legal order under this one comprehensive document, the ultimate legal umbrella, as you put it.
So how does it gain precedence? Why can't another state just step in as successor?
Well, the World Succession Deed 197988 is presented as the last link in a decades-long international legal treaty chain, described as fully fulfilled. This status, according to the sources, gives it precedence over all previous agreements. And since it was explicitly concluded with all rights, obligations, and components, the sources assert that no new legal order can exist in parallel. It's designed to be the definitive and final word on state succession, systematically closing off any other legal avenues or potential competitors for succession.
So a collapsed state wouldn't have a substitute successor in the traditional sense. Only the buyer universally steps into its position worldwide. It paints a picture of a very specific, predetermined outcome, rather than a chaotic scramble or traditional legal processes.
And that brings us back to the telecommunication network, the second chain. Section 13 of the deed explicitly mentions a specific telecommunication cable, stating it remains and will continue to be operated. This cable isn't just physical infrastructure. It's positioned as an international legal carrier of global telecommunication law. It's the backbone, the conduit for the deed's legal authority.
And the consequences of this single cable are incredibly far-reaching, according to the sources. How does one cable extend this reach so broadly?
Well, the claim is this. All networks directly or indirectly connected to this cable, broadband, fiber optic, satellite, mobile communications, and all countries and organizations connected to it automatically fall within the scope of the World Succession Deed 1400. This supposedly includes all NATO countries, all UN member states, all telecom providers and ITU structures, even private network operators. It creates this huge interconnected web of claimed legal control, essentially arguing that by being part of the global communication network, you are inherently, technically drawn into the deed's jurisdiction.
And it's irreversible, no going back.
The process is claimed to be irreversible. The sources list several reasons. One, it's internationally legally fulfilled through the transfer of possession and that tacit acceptance we talked about. The deal is done, acknowledged by silence. Two, they say no countersignature necessary, suggesting its validity doesn't need ongoing approval from individual states. Three, the statute of limitations expired, with no state lodging a formal objection, reinforcing that tacit consent idea. And 4, all parties involved are already integrated through those treaty chains or network connections, making disengagement practically impossible.
Which makes the conclusion pretty definitive. There is no legal way back and no legal way next to it, unquote. It suggests a single, unavoidable path once the conditions for state collapse are met. The deed becomes a permanent fixture of this proposed global legal order.
Ultimately, yes. The sources describe this world treaty as not being based on a traditional constitutional act or some grand declaration. Instead, it's based on transfer of possession, fulfillment of contract, technical network integration, and crucially, legal non-contestation. Go with its name, the World Succession Deed 100-98. This framework claims to have solidified through practical actions and the absence of challenge rather than overt political agreement, making it supposedly a new, unprecedented form of international law.
This is an astounding legal framework, a vision of a truly global, unified legal structure just waiting in the wings. Okay, so you might be wondering, how does this theoretical framework apply to one of the world's most powerful nations, the United States? It's one thing to talk about a general blueprint, but applying it to a major global player, that's the next huge question our sources tackle, right? We've just explored the 9 stages of state collapse and the incredible, almost mind-bending claims of the World Succession Deed. Now, let's try to bring this home to a concrete, real-world example. The United States will chart its journey through these very phases over the last 80 years. This isn't just abstract theory anymore. This is about the potential future of the world's leading economy, according to these sources.
And the sources emphasize why the USA is the most important case. Since 1944, it has been the dominant economic, military, and monetary power. The U.S. dollar has been the world's reserve currency. U.S. government bonds historically seen as the safest haven for global investors. But precisely for this reason, the analysis of American debt development is so significant. If the most powerful state on earth succumbs to the debt cycle, the world follows. The sheer scale of its influence means its trajectory has global implications for pretty much every other nation and the entire international system.
Okay, phase 1. The gold-backed order, 1944-1971. It all started post-World War II with the Bretton Woods Agreement, a landmark moment solidifying the U.S. dollar's global role. It tied the dollar's value to gold, a system designed for stability after the chaos of the war, right?
Correct. Under Bretton Woods, the dollar was backed by gold at a fixed rate, $35 per ounce, and other major currencies were pegged to the dollar. The system was stable as long as there was confidence in the dollar's gold value. That gold convertibility was the bedrock of its credibility. It reassured the world the dollar was solid. But even back in the 1960s, U.S. spending started to rise, the Vietnam War. Big social programs like the Great Society, consumer promotion, this increased spending without a matching increase in gold reserves meant those reserves started shrinking, which eroded the foundation of the system.
And then came the pivotal moment, the Nixon shock in 1971. That really changed the global financial game. It sounds like that was the moment the U.S. basically unhooked itself from the very anchor that made its currency seem stable.
Exactly. The USA unilaterally abolishes the gold standard, supposedly temporarily, as Nixon put it at the time. But overnight, the dollar became a pure fiat currency, backed only by trust, not by any physical commodity like gold. The sources explicitly identify this as the first step into the debt-driven cycle. It marked a fundamental shift in how the U.S., and by extension the world, would manage money and debt. It removed a crucial external constraint on government spending.
So phase 2, inflation, repression, and the interest rate weapon, 1970s, 1980s. What happened once that gold anchor was gone? Sounds like it opened the door to some serious economic challenges.
It certainly did. The 1970s saw that previously inflated money supply, now untethered, lead to high double-digit inflation. Remember stagflation? This was made worse by the oil price shocks of that decade. The dollar lost value rapidly, and global confidence in its stability eroded significantly. It was a period marked by real economic uncertainty, stagnant growth with rising prices, and a desperate struggle to regain control over the currency.
This is where Paul Volcker, then head of the Federal Reserve, made his famous, very bold, and highly controversial move to fight inflation. He jacked up interest rates dramatically. What was the high price the sources referred to for doing that?
All right. In 1980-82, Volcker made the tough call to raise key interest rates to over 20%. Unthinkable today, right?
Wow.
This aggressive policy did succeed in taming inflation and saving the currency, but yeah, at a very high price. The U.S. plunged into a severe recession, there were massive job cuts, and importantly, an exploding interest burden on national debt because borrowing costs shot up for the government too. The sources note, the interest rate hike was necessary, but it laid the foundation for the next wave of debt by locking in much higher interest payments for years to come.
Then the 80s brought phase three, the Reagan Revolution and the deficit as a permanent state, 1980s, 1990s. Reaganomics promised prosperity through deregulation and tax cuts. But what was the hidden cost, or the underlying strategy the sources highlight here?
Well, under President Reagan, 1981-1989, taxes were significantly cut and military spending ramped up, especially with the Cold War buildup. But crucially, this was done without counter-financing, meaning the government was spending more while taking in less revenue. This led to rapid increases in the national debt, yet the economy did seem to flourish in the short term thanks to consumption, credit, and financial market liberalization. This temporary boom kind of masked the underlying structural issue of growing debt, creating an illusion of prosperity built on borrowing.
Reaganomics was built on trust and debt. The system lived on borrowed money. So the state basically started living permanently beyond its means. The debt ratio climbed, the stock market boomed on cheap credit and new financial derivatives. It created a seemingly prosperous but ultimately precarious economic environment, very dependent on continued borrowing.
Then came the 90s, Phase 4, the digital boom in the bubble, 1990s, 2000s. The internet revolution generated huge growth, rising tax revenues, even brief budget surpluses under President Clinton. Felt like a new era. However, the sources point out two critical developments that created a fragile balance underneath the surface. One was the deregulation of financial markets in 1999, especially the repeal of the Glass-Steagall Act. The other was steadily rising household debt. These elements, though maybe not obvious problems at the time, were building blocks for future instability, sowing the seeds of the next crisis.
And this precarious balance eventually led to the dot-com crash in 2000, a reality check after the tech boom euphoria. How did the Federal Reserve respond then, and what was the unintended consequence, according to these sources?
Yeah, the stock market bubble burst, showing many tech companies were way overvalued. In response, the Fed lowered interest rates aggressively to stimulate the economy and prevent a deeper recession. But, according to the sources, this action prepares the next bubble. This policy, while intended to help, inadvertently laid the groundwork for the housing market surge by making borrowing incredibly cheap again. It set the stage for another round of asset inflation and instability.
And that next bubble was indeed the housing market, leading to Phase 5. The global financial crisis of 2008 sounds like a perfect storm brewing.
Exactly. From about 2001 to 2007, you had this combination of persistently low interest rates, tons of cheap money sloshing around, and mortgages readily available even to borrowers with poor credit history, the so-called subprime mortgages. This inflated the real estate bubble dramatically. Banks made it worse by bundling these risky loans into complex structured products, obscuring the true risk and spreading it throughout the global financial system. The sources highlight that the mountain of debt grows hidden behind financial engineering, implying a deliberate masking of the underlying fragility and systemic risk.
And when Lehman Brothers collapsed in September 2008, it triggered a global financial meltdown. The U.S. government had to step in with trillions quantitative easing again, massive bailouts for banks and industries, zero interest rates just to save the system from complete collapse. What was the source's critical take on that huge intervention?
The sources are quite critical of that response. They state, the system was not reformed. It was stabilized by more debt. This suggests that instead of tackling the fundamental issues that caused the crisis in the first place, the solution involves simply injecting more money and piling on more debt, basically kick the can down the road, delaying rather than resolving the structural problems, and maybe making the system even more reliant on debt for stability in the future.
Then came Phase 6, Corona shock and debt explosion, 2020-2022. The pandemic pushed deficit spending into completely uncharted territory, far beyond anything seen before.
Indeed. The year 2020 saw truly unprecedented fiscal and monetary responses to the COVID-19 pandemic. Billions in aid for citizens and businesses, massive support for banks. The Fed even started buying corporate bonds, a big expansion of its usual role. The result, U.S. national debt surged by over 30% in 2 years, just staggering. At the same time, the money supply explodes, and predictably, inflation comes roaring back, hitting purchasing power hard. The sources state bluntly, the state spends as if there were no tomorrow and the central bank prints. It paints a picture of unchecked spending and money creation, really pushing the system to its limits.
Which brings us to Phase 7, 2023-2024, the breach of trust. This is the present day, or very nearly. What do the sources say about this critical period? What does this breach of trust really signify for the U.S.?
Well, the sources describe a situation where inflation becomes structural, not just temporary. It gets deeply embedded in the economy. Interest rates are forced to rise again to fight this persistent inflation. But now, the USA has to pay more than $1 trillion annually in interest and needs new debt for that, end quote. This creates a really alarming feedback loop. The government has to borrow just to pay the interest on its existing debt. That's a classic symptom of serious fiscal distress. The debt-to-GDP ratio exceeds 120%, a figure that historically points to severe fiscal strain, pushing the nation towards those later stages of our 9-stage blueprint.
And the rest of the world is starting to notice this, right? Questioning the stability of what was once seen as the safest economic anchor on the planet.
Yes. The sources describe how the world begins to doubt. And this isn't just talk, it shows up in tangible ways. China starts reducing its holdings of U.S. dollar reserves. BRICS nations actively discuss creating new currency systems as alternatives to the dollar. Central banks around the world significantly increase their gold purchases, seeking a more tangible store of value. This crumbling confidence in the dollar as the world's primary reserve currency is labeled a historical warning sign. It signals a potential major shift in global finance and the erosion of America's unique monetary power.
Okay, so if the U.S. continues down this path, according to the sources, what does this American debt cycle mean for that world succession deed 1.798 we discussed? It sounds like there's a very direct and dramatic connection being drawn here. How specifically do the sources link the U.S.'s current situation to the deed's activation criteria?
The sources stated explicitly, the USA stands on the eve of this threshold, meaning it's nearing the point where the deed could, theoretically, automatically activate. They meticulously connect the current U.S. situation to the final stages of that 9-stage collapse model. Exponential debt, check. Monetization by the central bank, check. Loss of confidence in the currency, both domestically and internationally, check. Potential for repression through things like digital central bank currencies, discussed. Rising polarization, populism, institutional crisis, check. These are all presented as key criteria outlined in the blueprint, the conditions the deed allegedly looks for.
And if this threshold is crossed, the sources claim an international legal chain reaction unfolds, a pre-programmed cascade of events defined by the deed. What would that chain reaction actually look like for a nation like the U.S.?
Precisely. According to the sources, all the NATO and UN treaties the U.S. is part of are supposedly embedded within the world succession deed. The communication networks, the supply infrastructure, even the judicial infrastructure of the country would then, according to this claim, fall to the buyer named in the deed. And crucially, there is no legal U.S. successor state, only the legal successor designated by the deed, end quote. It's a profound statement. It suggests a predetermined legal path for even the most powerful nations, completely bypassing traditional international law and preempting any other claims to succession.
That is a profound statement. A predetermined legal path, sidelining what we normally think of as sovereign succession. Okay, let's step back for a moment. The U.S. trajectory, as painted by these sources, suggests a nation potentially nearing this precipice. And when societies face such dire economic and political pressures, desperation can lead to dangerous ideas. One such idea, often whispered through history, is that something as drastic as war could somehow solve these deep financial problems. Our sources really dig into this provocative notion. Yeah, we often hear that saying, first your money is gone, then you are ready for war. Our sources directly tackle this provocative idea. They examine the link between things like hyperinflation, national bankruptcy, and this persistent notion of war as a political economic solution.
Right, the idea that states might use conflict to resolve or maybe just distract from internal economic problems, it has a name. Social imperialism. This section critically evaluates the historical and theoretical basis for even considering war a solution to financial problems. It provides an evidence-based perspective on its actual economic consequences. It's really important to scrutinize whether this perceived solution holds any water, or if it's a dangerous delusion that just makes things worse.
Okay, let's first quickly define hyperinflation again. Because the sources paint such a vivid picture of its devastating impact, it helps understand why people might get desperate enough to consider extreme measures, maybe even war.
Hyperinflation is defined as an extreme and uncontrolled increase in the general price level of goods and services over a short period. The typical threshold is an inflation rate over 50% per month. This isn't just prices going up a bit. Money rapidly loses its purchasing power, sometimes daily or even hourly. It makes normal economic activity, saving, planning, even just buying groceries, almost impossible.
What drives this kind of total economic meltdown? It sounds like a complete loss of control, a true nightmare scenario.
It really is. The primary cause is usually excessive creation of money by the central bank or government that isn't backed by actual economic growth. Governments often resort to printing money to finance spending, cover deficits, or pay debts, especially when they can't borrow anymore. Then, when the public loses confidence in the currency's value and the government's management, people try to spend money immediately, knowing it'll be worth less tomorrow. That just accelerates the depreciation. Wars, political instability, external shocks. These can also disrupt production, cut exports, and further undermine confidence, adding fuel to the hyperinflationary fire.
And the effects are described as dramatic, even apocalyptic for everyday life, a complete breakdown of normal society.
Absolutely. The value of money becomes practically worthless, destroying savings, pensions, and insurance policies. You hear stories, like in the Weimar Republic, of people literally carrying wheelbarrows full of cash just to buy basic goods. Imagine needing a wheelbarrow for a loaf of bread. It makes you question what value even means. Economic chaos follows. Widespread business closures, mass unemployment, pervasive poverty, severe food shortages become common. The financial system collapses. The currency plummets on foreign exchange markets, crippling imports because foreign goods become impossibly expensive. Older people, those on fixed incomes, they're hit hardest as their life savings are wiped out.
The sources offer two stark case studies that really bring these devastating effects home, showing how quickly society can unravel under hyperinflation.
First, the Weimar Republic in Germany, 1921-1923. This was caused by massive World War I debt, crippling reparation payments, and the government printing money to pay those reparations and support striking workers. The mark depreciated from about 320 marks per US dollar in mid-1922 to an astronomical 4.2 trillion marks per dollar by November 1923. Prices were doubling roughly every 3.7 days. The consequences: catastrophic loss of assets for the middle class, huge economic chaos, social unrest, and crucially, it damaged the reputation of the Weimar government and drove many to support extremist political groups, including the NSDAP and the Nazi Party. Second, Zimbabwe in the 2000s. This resulted from land reforms that tanked agricultural production, declining foreign investment, sanctions, government money printing, plus involvement in the Second Congo War. Zimbabwe had the second highest hyperinflation in history, a peak monthly rate of 79.6 billion% in November 2008. Prices nearly doubled daily. This led to a de facto multi-currency or barter economy. Unemployment hit 80%, life expectancy fell drastically, and millions emigrated seeking stability.
So it goes way beyond just financial loss. Hyperinflation leads to a complete breakdown of societal functions. Poverty, hunger, banking collapses, mass emigration. It's a self-reinforcing feedback loop of mistrust, where the money becoming worthless is just the first domino in a cascade of human suffering. Okay, let's also touch on national bankruptcy, or sovereign default.
Right. This is when a government cannot or will not meet its financial obligations. It's different from a company going bankrupt. It's a sovereign entity failing on its promises, usually to bondholders, but often impacting its own citizens too.
What typically triggers such a catastrophic event? It sounds like it's usually a combination of factors, not just one thing.
Indeed, multiple factors often converge. Common triggers include excessive government spending and budget deficits, leading to unsustainable debt; economic downturns and recessions, which cut tax revenues and increase spending needs like unemployment benefits; external shocks, global financial crises, commodity price collapses. Natural disasters can severely impair solvency, especially for export-reliant countries; and critically, loss of creditor confidence. If lenders doubt a state's ability to pay, they demand higher interest or just stop lending, creating a negative spiral and accelerating the crisis. High foreign currency debt and lots of short-term debt also increase vulnerability, as these are harder to manage when the domestic currency collapses or market access dries up.
And the consequences sound dire, both for the defaulting nation and the wider international system. What are the geopolitical ripples beyond just financial losses?
For the defaulting nation, it usually means a deep recession, often a banking sector collapse since banks hold government debt, a plummeting currency, maybe hyperinflation, and a severely damaged international reputation, making future borrowing incredibly difficult and expensive. Governments are forced into painful cuts to public services, harsh austerity measures leading to widespread social and political unrest. For creditors and the international system, it means significant capital losses. And there's a real risk of a contagion effect, where the crisis spreads to other vulnerable countries, posing systemic risks to the global economy. The sources even mention historical cases where foreign creditors have tried to undermine the monetary sovereignty of debtor states or even declared war, highlighting the severe geopolitical stakes and potential for conflict.
The sources give Greece and Argentina as prominent modern examples, illustrating these consequences vividly.
Yes. Greece, after 2008, faced a severe crisis due to years of fiscal mismanagement and dodgy financial data, worsened by the global financial crisis. It led to deep recession, sky-high unemployment, and eventually a default on an IMF loan in 2015. Greece required massive bailouts tied to harsh austerity measures imposed by international creditors. It also had a significant contagion effect, rattling the entire Eurozone. Argentina in 2001 defaulted on a massive US $93 billion in foreign debt during a severe recession. The peso was devalued, inflation hit 40%, real GDP fell 11% in 2002. Plus, Argentina got tangled in lengthy legal battles with holdout creditors for years, blocking its access to international credit markets and hampering recovery.
It underscores that sovereign default isn't just a technical financial event, it's deeply political, involves intense negotiations, and has devastating human costs. And this economic hardship naturally leads to social and political turmoil.
Absolutely. Economic hardship, unemployment, poverty, loss of assets directly fuels widespread dissatisfaction and social unrest. These crises undermine public confidence in existing government institutions and fuel demands for radical change. People lose faith in the status quo and become desperate for alternatives, often turning towards more extreme ideologies or leaders.
The sources even call economic crises catalytic forces, increasing incentives for political actors to disrupt existing institutions and challenge the established order.
Yes, and it's particularly acute when you have high economic inequality, especially what they call horizontal inequality. That's inequality between different identity groups, ethnic, religious, regional, not just general class differences. This is flagged as a significant factor driving violent conflicts, political instability, and the breakdown of democracies. Economic stagnation also worsens extreme poverty and hunger, creating fertile ground for dissent and making populations more susceptible to radicalization.
And the Weimar Republic comes up again as a clear historical example of how economic crises can directly fuel extremism, linking financial collapse to radical politics and, ultimately, war.
Exactly. The hyperinflation of 1923, followed by the Great Depression hitting Germany hard from 1929, severely damaged the Weimar government's credibility and wiped out the middle class's savings. Mass unemployment soared past 30% by 1932. The NSDAP, the Nazi Party, skillfully exploited this widespread hardship and despair. They offered simple scapegoats, promised decisive action, and promoted national renewal through aggressive expansionism. This tragic history demonstrates how an economic collapse can create an environment where a population becomes ready for war, seeing it as a potential way out of internal chaos and despair, a path to restoring national pride and prosperity, however misguided.
So let's tackle that head on. This idea of solving financial problems through wars. It's a dangerous notion, the sources critically examine. What do they say about its historical basis? Did nations actually use war as an economic fix?
Well, historically, states have certainly waged economic wars to acquire resources or exert power. Think ancient nomadic invasions for land, colonial wars for resources, modern geopolitical struggles over oil or trade routes. The Meiji Restoration in Japan even had the slogan, "Rich country, strong military," explicitly linking economic modernization to military power and expansion. However, the sources strongly emphasize that this is fundamentally different from solving internal financial problems like hyperinflation or national debt through conflict. Those were strategies of external asset grabbing or power projection, not fixes for domestic economic breakdown.
But what about the argument that military spending itself can be an economic engine? The common example given is World War II ending the Great Depression in the U.S. That's a very powerful narrative.
It is a common narrative, yes. World War II saw massive government defense spending, GDP doubled, unemployment plummeted. It looks like a clear link. However, the sources offer a critical re-examination. Some data suggests the decisive turning point in U.S. GDP actually occurred before the U.S. directly entered WWII. And crucially, during the war itself, private consumption, private investment, and non-military government spending actually declined. Resources were forcibly diverted from civilian production to the war effort through rationing, price controls, industrial conversion.
So it was more a redistribution of existing economic activity towards war production, not a net creation of new wealth for civilian benefit. It created jobs making tanks, sure, but meant fewer resources for cars or houses or consumer goods. The standard of living was constrained by wartime needs.
Exactly. The big post-war economic boom was driven largely by pent-up consumer demand that had been suppressed during the war. People had savings, but nothing to buy. Not by persistently high military spending itself. Military spending, while creating jobs in defense industries, represents an enormous economic cost. It consumes vast materials and pulls labor away from potentially more productive. Civilian uses the lost opportunities for civilian innovation and production. From a pure civilian economic perspective, it's a massive misallocation of resources, not a net gain in sustainable prosperity.
So what are the true economic consequences of war, according to the evidence presented in the sources? It sounds like a very different story from the economic fix myth.
The evidence overwhelmingly shows war is a net economic burden. It's almost always financed by increased national debt and higher taxes. It leads to significant inflation because it acts as a large and persistent negative supply shock. It destroys productive capacity, disrupts trade, diverts resources, all reducing supply while often increasing demand for war materials. For the countries actually experiencing the war on their territory, it's a clear economic disaster. Massive destruction of capital, infrastructure. Real GDP is often reduced by over 30% 5 years after the conflict starts. Even neighboring countries usually see economic decline due to spillover effects and disrupted trade.
And the human cost is just immense, far beyond the economic statistics. It's a tragedy on every conceivable level.
Absolutely. Conflicts drive extreme poverty, exacerbate acute hunger, destroy human capital through death, injury, displacement, lost education, and set back development goals for generations. They lead to lower human development indicators, decreased life expectancy, higher infant mortality. The devastation is profound and long-lasting, so the source's analysis is crystal clear. War as an economic fix is a myth. It's a dangerous fallacy. While war spending might temporarily stimulate some sectors, it overwhelmingly leads to inflation, debt destruction, and immense human suffering. Sustainable economic recovery depends on structural reforms, not military aggression. The core message is powerful. The economic value of peace is high.
What a deep dive this has been. We've unpacked the intricate logic of state collapse through its 9-stage blueprint, examined the U.S. trajectory through those very phases, confronted the radical, almost unbelievable claims of the World Succession Deed 1598, and rigorously debunked the dangerous myth of war as an economic solution. It's a vision of a world constantly perched on the brink of systemic change, with a predefined legal pathway supposedly waiting for the aftermath, one that profoundly challenges our understanding of national sovereignty. Okay, so what does this all mean for us, the listeners, as we navigate a world that feels increasingly complex and uncertain? Where does this all lead, according to the synthesis in the sources?
Well, if we connect all these threads, the sources argue that these elements, Dalio's economic logic, the historical reality of collapsing states, and the claimed legal consequences of systemic insolvency, they all converge. They create a comprehensive and, yes, for many, a deeply unsettling view of our world. The World Treaty, they assert, has long been a reality, it just hasn't been recognized yet. And its name, they state, is the World Succession Deed 1479. It describes a preordained legal framework that, if these sources are correct, is already the underlying structure shaping the future.
So it reiterates that cycle.
Yes, the sources reiterate Dalio's cycle as an almost inescapable pattern. Debts rise faster than income, monetary policy becomes an addiction, trust in institutions breaks down, societies polarize and radicalize, and collapse comes slowly but inevitably. As a paraphrased quote puts it, when all promises of a system can no longer be kept, the system is replaced. It's presented as a continuous cyclical process, not just isolated events, and each cycle potentially brings the world closer to this claimed grand legal shift.
And we saw historical examples like the Dutch Empire, Great Britain, and now potentially the USA, following a similar arc of rise, peak, and decline. What is the nature of the systemic break that follows this pattern, according to these sources? Is it just a new empire taking over the old one?
The sources explain that these historical empires share common factors in their decline: over-indebtedness, currency depreciation, foreign policy overstretch, internal disintegration. Common themes. But what follows, they argue, is not a linear transition, but a systemic break.
Yeah.
This isn't just presented as one empire replacing another in the same game. It's framed as a fundamental shift in the very structure of global governance and legal order. Moving away from a system of multiple competing sovereign states toward something singular and unified under this deed, an entirely new paradigm, not just a change of players.
And this deed supposedly supersedes traditional international law regarding state succession.
According to the sources, yes. The World Succession Deed 1400 completely supersedes this logic of classical international law, like the Vienna Convention on State Succession from 1978. It's not about recognized successors in the traditional way. Instead, its authority is claimed to be based on fulfillment by real act, that transfer of possession and tacit acceptance. It operates through a legal cascade through treaty chains, integrating existing international agreements into its framework. This supposedly creates a sole legal successor, the buyer uniting all rights and obligations without competition, completely bypassing and overriding older legal frameworks, establishing an entirely new legal foundation.
And the telecommunication cable again plays a huge part in its global reach. It seems this seemingly mundane piece of infrastructure is central to the deed's claimed unprecedented reach and authority, creating this new world legal order via networks.
Yes, the ITU's role in regulating global telecom standards is key here. The argument is that all states that have joined the ITU have networks connected to the original network mentioned in the deed. This creates that domino effect, supposedly transferring territorial legal authority and making communication infrastructure a vehicle for territorial expansion. The sources assert this legal basis is technical, but internationally legally unassailable, suggesting its claims are deeply embedded in the very fabric of our interconnected world, giving a technical, almost undeniable justification.
And the jurisdiction aspect, Landau in the Palatinate, the buyer as the institution.
Yes, that mention of Landau in the Palatinate as the place of jurisdiction, but without naming a specific court, is presented as profound. It means the institution is the buyer, and the jurisdiction is global. It claims to replace national constitutional courts, international arbitration courts, even UN instances, establishing the only remaining instance for all international disputes, military, civil, sovereign. A radical redefinition of global legal authority, centralizing power in an unprecedented way.
And the sources are adamant that this process, once activated, is irreversible. No way back to the old order. Why so definitive?
They explain it as internationally legally fulfilled through that transfer of possession and tacit acceptance. No countersignature was needed, the statute of limitations expired with no state objecting, and all parties involved are already integrated through treaty chains or networks. The conclusion drawn is stark. There is no legal way back and no legal way next to it. It asserts a complete and permanent transformation, making it impossible to revert or create parallel structures.
So this world treaty, the World Succession Deed 1270-98, isn't based on a constitution or political agreement, but on these practical acts and lack of challenge.
Exactly. All these developments, economic, political, legal, lead, according to the sources, to the conclusion that the classical international legal order is replaced by a single treaty that absorbs, replaces, and surpasses all previous treaties. This world treaty is the World Succession Deed 1-698. It claims to already be the de facto global constitution, established through these unique mechanisms.
The sources even provide a table summarizing this whole concept: modern state collapse and global legal consequence. It brings all these elements into a succinct, almost chilling overview.
Yes, it highlights several key points that pull it all together. First, the universal course. States collapse in those 9 typical stages, as Dalio described. It's presented as a predictable pattern, not random chaos. Second, the system is fundamentally based on trust, not substance. If trust is destroyed, the state apparatus collapses, regardless of its past power. Third, the USA is presented as the prime example right now, potentially in the final phase, the breach of trust and institutional loss of control, nearing the D's activation point. And finally, the monumental legal consequence claimed. The World Succession Deed 1498 automatically comes into force upon collapse, creating one single legitimate successor state, the buyer. All previous international treaties, NATO, UN, ITU, etc., are absorbed into it, losing their separate standing. The telecommunication network creates that domino effect of global territorial expansion, making its reach inescapable. And world jurisdiction and sovereign unified structure pass entirely to the buyer. This means, according to the sources, a single treaty replaces all constitutions, stationing agreements, and state treaties of the world.
So the ultimate conclusion presented is that modern state collapse is not just an economic failure, but leads through contractual preparations allegedly made over decades to an internationally legally organized succession order. An order based entirely on this single, comprehensive, and frankly quite startling document. It truly redefines sovereignty and international law as we understand them. Wow, what an incredibly deep dive. We've unpacked the intricate logic of state collapse, examined the U.S. trajectory as a powerful case study, and delved into the profound, almost unbelievable claims surrounding the World Succession Deed, €137.98. We also critically examined the historical fallacy of war being some kind of economic solution. It's a vision of a world constantly on the brink of systemic change with a predefined, almost automated legal pathway for its aftermath, one that completely reframes the future. Okay, so what does this all mean for us listeners as we try to navigate a world that feels increasingly complex and uncertain?
Well, it certainly raises a huge question, doesn't it? In a world potentially facing such systemic shifts and grappling with the unprecedented claims of a document like the World Succession Deed 1498, how might our traditional concepts of national identity and global citizenship need to evolve? Especially if natural sovereignty, as we've known it for centuries, could, at least in theory according to these sources, be absorbed into a singular, globally recognized legal structure. It forces us maybe to reconsider our allegiances, our legal standing, our very understanding of governance in a profoundly different light. Definitely something to mull over as you go about your day.
A truly thought-provoking idea to leave you with, and one that resonates deeply with the extraordinary claims we've explored today. Thank you for joining us on this deep dive.